copper in our fund, it's our biggest single commodity exposure. It's about 30% of the fund. We're very bullish on the outlook there.
It feels like a buy the dip kind of moment for a lot of people out there.
But I don't understand the non-gold ones that they've got.
Alrighty, Dave Franklyn, fourth time on the show. We're thrilled to have you back. Thanks for joining us again.
No, thank you, JD and Trav. Good to be back and looking forward to the chat.
Well, we've exhausted or refreshed given the market?
A bit of both, really. You know, I think there's always things that keep you interested, isn't there? So, and always value opportunities. So
we've got no shortage of things to talk about today. Yeah. So we're going to kick things off talking a bit of macro. We're going to run through all the commodities: uranium, copper, gold, precious more broadly, and then we've got a bunch of quarterlies to jump through as well. So we're going to jump through the highlights and the lowlights, and then US Antimony Corp. What else?
Don't forget the deals, mate. Big raises, rare earth financings, antimony takeover deals. US government's in around the mix, and retail's up and about, mate. Shareholders are interested. People are buying stocks again. Maybe not the best stocks all of the time, but you know what? Retail is back, and it kind of makes me happy when retail's around. I'm sure it makes a difference to institutional investors as well, Dave, because you need retail flow to get a liquidity re-rate if you play at the lower end of the curve.
I think you're right. I think last time I was on, I was talking about being an institutional investor. You go through periods where you just try not to lose money, and then you're going through periods where you're making money. And we're very much in that phase now where, you know, we're making money in the fund and investors are making money and retail investors are coming in and it all looks good. So let's hope it continues on.
Long may it continue. All right, guys, let's kick off with uranium talk. So big deal overnight between the US government and also involving Westinghouse Electric, Cameco and Brookfield. So Cameco was up 25% on this one. Essentially, we're talking about Trump's push for energy dominance. The headline is an $80 billion rather price tag that's going to be written. Japan is going to get involved as well, and they are building reactors in the States again. So there's a few financials, but the details are still relatively light on. But it's about sentiment. It's about things happening. It's about Japan getting involved. It's in the lead up of Trump going to speak with Xi, and potentially another big trade deal. So there's lots in the works here, and it comes at a very interesting time because the US hasn't built a big reactor in a long time. Vogtle was the last one they built, and that blew out by 2.5 times, cost $35 billion, so leaves a bit to be desired there. But reactors are a very, very big ticket item. They cost a lot of money, so you kind of need the government to get involved to hold the hands of the likes of Brookfield and other massive capital allocators. But when you sort of hear this hit the wires, what's your kind of first thoughts on this one, Dave?
Yeah, look, I reckon it's a very significant announcement because if you look at the uranium sector, the thing that it's lacked is urgency, right? You've had Cameco and Kazatomprom sort of plodding along. You've had the utilities under no real rush to sign up deals. While everyone's talking about building new reactors, they take a long time and cost a lot of money. And I think this changes it. Just says, okay, the US is saying we're serious about nuclear power and we're going to get on and do it. So I think it's one of the most significant announcements that has come out in the sector, in recent times.
Huge.
Yeah,
huge. What I found really interesting though about it was like $80 billion fund. Just a tiny detail, $80 billion to be allocated to build out these new reactors. The only thing missing in the release was how many reactors is that? How many reactors they're going to build out with that $80 billion?
I guess it comes to the size of the reactor, right? But it's probably something like 8 or 10. I would have thought.
FT estimated 8, but anyway, so there's a bit to play out here.
With the Japanese, they start talking about helping out with SMRs and these sorts of things, which is obviously a much smaller ticket. So we'll kind of see, but keen to see a lot of numbers. And I think you get to a point in time, 80 billion and above, and the numbers start to not mean an awful lot. They're such big numbers. They were talking at the same time about the Japanese coming in investing $300+ billion in the States in various infrastructure projects, not just uranium, but it's a vast amount of money that needs to be spent, and the big tech companies are keen to get involved and do their thing as well. We saw Google come out with a deal earlier this week because the kick up in energy demand, they need the demand for the data centers.
Super encouraging to see the urgency of trying to create energy abundance in all forms. I think that policy's a very wise one. There's a bit to play out, long timelines associated with it all. At some stage, the question is going to certainly need to be asked, where is all the uranium going to come from, right? And I wonder if this is the announcement that comes before we're actually going to get another announcement, and that is a strategic uranium reserve announcement. What do you think of that, Dave?
Yeah, look, I don't think there's a shortage of uranium when it's kind of economics wins, right? So when the price is high enough to incentivise and you've got government support, then I think it'll happen. So I don't, and obviously Australia has a big resource. Canada has a huge resource. It's just a matter of getting on and doing it. And I think what this shows is demand is building, and that's good for pricing. So yeah, I think it's heading in the right direction.
So we'd kicked about the idea of these types of groups, Brookfield type names, getting involved in the nuclear space in the past. And I want to go one step further. Can you see a world in which they would get involved at a project level in some shape or form, just to just seeing the opportunity there and the economics of a project for a commodity where the demand you can map out a bit better than you can with other commodities?
Yeah, well, I think you're right. Really, they're big ticket projects, whether it's building a reactor or whether it's developing a mine. And so you need people that have, and groups that have, long-term horizons. So the Brookfields of the world are well placed for that, and governments are well placed for that. So I think you're right. I think you'll see capital allocated to that sector. It's moving into the mainstream. For a long time, it's been on the edge, but I think this really creates the momentum to have money directed at it.
The infrastructure funds of the world, they need, very, very long-term, contracts at a price that, is to some degree inflation resistant and fixed. And, uranium supplying a reactor, it fits the mold of an infrastructure like cash flow dynamic that you can have the certainty of price on FID of these reactors. I think the application of that financing dynamic into the mining world is it's cool. Like, when you last read the big score, what was the relevance where a Brookfield consortium or the previous incarnation of Brookfield was involved in some way, shape, or form in the nickel market?
Oh, you're testing my memory here, but it was the previous incarnation of the Canadian group that
ultimately became Brookfield,
that got involved, and they tried to partner up with other groups and do a deal for American diamond fields.
Yeah, so it's that analogy that I know you've held NextGen in the past, Dave. Don't know if you've still got it as a core portfolio position, but the strategic value of Arrow, it only goes up in this sort of world, right?
Well, totally. Really, there's not many large, long-term, high production assets out there. Arrow is one. Denison, slightly different style of asset, but that's coming on. But they're both, they're both nearing their final approvals. So you're seeing some major projects coming forward, and there's a few others. We own ISO Energy, which is actually 30% owned by NextGen. That has a cracking deposit in the Athabasca called Hurricane, which also looks really interesting. So
recently merged with Toro.
So takeover. So it's much bigger than Toro. But again, that's an interesting angle where they're saying we've got great assets in other parts of the world, but let's put our foot on some decent scale, earlier stage development assets in Australia, which I think is an indication that how they see the geopolitical situation changing in Australia towards. Yeah.
Very keen to see how it changes and the landscape and the permitting changes here in our state and in our country more broadly. Why don't we move on to gold, guys? Been a super volatile time. If we zoom out far enough, Dave, since you last came on and since you first came on, it's just been a one-way street. But try telling that to people when it's come off 10% in the last week or so. But if you look at the average price, like we spoke about before, for 2025, still $3,200. And we're sitting at $4,000 right now. Jumping over to silver just quickly, that's also down by a similar margin, maybe a bit more. It's got that kind of torque to it from 55 to 47 odd bucks. But There seems to me, I'm curious to just sort of gauge the sentiment with you first. It feels like a bit buy the dip kind of moment for a lot of people out there. A lot of people that have cash around are sitting pretty happy because some of these stocks have peeled off 20+% in the last week or so. Am I picking up on the same sentiment that you are there?
Yeah, I think so. I mean, I think there's a number of factors there, as you alluded. I mean, gold price has had a huge run, and between I think the 20th of August and the 20th of October, 2 months, the US gold price rose by $1,000, 30%.
That's crazy,
right? Which is incredible. And now it's pulled back 10%, and you're right, people are going, we're worried here. So I think that the tailwinds for gold that we all talk about, debasement of US dollar, geopolitical risk, interest rates coming down, etc. They're all still in place. So you got to be bullish on gold. But having said that, the rapid rise in the gold price was accompanied by the even more rapid rise in gold equity prices. So there is a bit of a consolidation that I think needed to happen. So we think that you could see a bit more consolidation, a bit of a stabilisation, but ultimately I think you want to have gold in your portfolio.
A sustainable rally is not when price just goes, vertical. That you do want it to be. Have periods of having a breather. And back up again.
I think the other fact, what's interesting is, what's driven gold price particularly recently, and what you've seen is a lot of buying in ETFs, gold physical ETFs out of the US, right? And historically that's been pretty fickle, right? So the last time you saw that was COVID, where it was really panic driven. This time I think there's a bit of panic. On one side there's people that are worried about what's happening in the world, but on the other side I think you got people jumping into gold because they think they've missed it, right? So there's kind of a combination of fear on one side and greed on the other, right? That's been driving it. And just as that happened, you get a pullback. So momentum wise, you might just need a bit of a settling down period. But yeah.
Well, I don't think we've actually spoken about it on the show yet, but the lines at the Perth Mint, at the ABC refinery in Sydney, people queuing up for 5-6 hours to buy a small bar of gold. I find that I didn't have that on the bingo card for this year.
It's funny how you get the physical ability to see the interest in some ways, but it's just a physical manifestation of more volume. You know what I mean? That's when you get more market depth on the screen, that's the same thing. More people wanting to buy and at a higher price, more people wanting to sell.
So on the flip side to that, the central bank action, as you mentioned, is quite interesting, Dave. And we've seen huge central bank buying from the likes of Poland, Turkey, China, these sorts of countries. And we are starting to see a couple more countries talk about this. I think Korea mentioned in the past week or so that they would look at adding gold to their reserves. Gold as an asset class, you shared a great chart the other day, Trav. Gold as an asset class for central bank holdings is now just shy of US dollars, and they have been sort of converging. It's outstripped yen, euro, all these other things. It's a combination, obviously, of the buying as well as the increase in price and the overall value of it going up. But they, we like to think they don't operate the same way as retail investors. They get orders to execute and they just go at it until they're kind of done. That's the kind of common wisdom of how they do it.
I feel like that's like a fraught analogy. The masters of our currency, not thinking like retail investors. The international central bank community is full of groupthink. They all do the same thing at the same time. I don't think you have original thoughts. They copy each other, and when they all do something, they all do something at the same time. So
couldn't agree more. I think more in the execution of how they do it.
The trade, sure. But to the extent of should we be surprised that all of a sudden every central bank is pretty concerned about holding more US dollars and gold? No. In fact, it's the gradually then suddenly kind of thing that plays out, and central banks are susceptible to more groupthink than retail, in my opinion.
We've seen it time and time again through the 90s. They all got on board and sold together, and every one of them just sold at the same time until the lows of whatever it was, $250 by the end of the 90s, and then we've seen the reverse.
I think you're right. It's, a lot of it is risk management, isn't it? You're saying we've got too much of our assets in US dollars, and where else can we put it? And when you look at it that way, there's not many places you can put it, right? So gold really stands out. So that's what we're looking to do. But I think in this day and age, the question is, should you be holding stockpiles of copper, for example, because it's very hard, as far as a value proposition over the next 50 years, it looks pretty compelling. So I think there is an argument to say, hard commodities will be recognised for their sort of intrinsic value, which hasn't really been a factor.
The metal content of the 20-cent Australian coin or the nickels in the US are... Yeah. I think they're at par or above par now. So hoard your coins. Yeah, Dave, advice from me.
if you've got any left,
melt them down. Yeah.
So on that segue, let's jump into copper. Copper's been a really interesting place. That's also up 25% through to where we are like year to date, and we are talking about mine closures and mine guidance revisions in Chile, in Peru, in Indonesia, in the DRC, in every sort of corner of the world. You've got the smelting and refining market tightening and ebbing and flowing as well. So it's a super interesting space, and I think the sentiment there is as kind of constructive as I've seen it in the recent history. So how do you kind of feel about that? How do you position yourself in light of that sort of feeling?
Yeah, look, copper in our fund, it's our biggest single commodity exposure. It's about 30% of the fund. So, we're very bullish on the outlook there. And that's because a number of factors. Firstly, it's a big market. You're talking 25 million tonnes per annum. China's obviously a big buyer of copper, but it's not a dominant and influential. It doesn't set the price. So it's a big market and operates effectively, which is good. If you look on the demand side, you've got a whole lot of demand drivers. You've got the normal sort of industrial growth. You've got data centres. You've got defence, etc. So there's a whole range of demand. And then on the supply side, as you're saying, you've got 40% of production coming out of Chile and Peru, and they're subject to social unrest and issues around production curtailments. You've got production coming out of Africa, which we've seen recently where there's been some issues. So you've got sort of strong demand and constrained supply, which bodes really well. So we like it.
Yeah. There's a lot to like, and I mean there's been a lot to like about copper for quite some time, but it does feel as if things are moving in the right direction there. If we jump into the quarterly reports, starting with a copper-ish name, Develop, that's an interesting one. You've held that in the past. They are ramping up at Woodlawn. They are talking about nameplate there by March 2026. Recoveries are sort of improving. There was a bit kind of fraught at the ramp-up kind of stage, and then they're talking about the Kate lens, which is going to be the honeypot for the first kind of couple years. But how are you thinking about it? How are you positioned in it at the moment?
Yeah, so we see it's a stock where you probably don't want to just sit and hold. So, we've been in and out of it a bit. We've been buying a bit more recently, particularly after the quarterly, which the market sort of had some concerns with. The way we look at it is Woodlawn is a project in ramp up. I think you've got to evaluate it on how it goes in the March quarter. But you're right, the Kate lens, kicks in then. Grades will be good, and we think that'll sort of lead to a re-rating. You've obviously got Sulphur Springs going through the final stages of assessment with the FID probably mid next year. If you want to back one guy in resources, I think it's Bill. So we're really bullish on the story, and it's now moved into our top 5 holdings. And we'll probably continue to chip away and add to that.
I'm really curious about your comment about it not being one you kind of hold for the long term there, Dave. Is that because the assets aren't first quartile, or where do you kind of come from when you say that?
It's more market sentiment. So what you tend to see is the price can move up above where we would assess as reasonable value. Just on momentum. and so often in those situations we'll take some profits and then come back in. But the way we kind of more generally look at how we assess companies is we kind of have an investable universe, right? And sometimes we might sell those companies and sometimes we might be buying those companies, but ultimately they've kind of ticked all the boxes as far as something that we want to own and develop certainly in that box. It's just that sometimes from a valuation perspective it can get overpriced. And as I think we're seeing now, sometimes it gets oversold, and so that's where we want to be able to come in.
There's a bit of activity that is about in the copper space. Like, there are deals that can be done, and we know that Develop is Bill in particular is a guy that does deals.
Yeah,
creates value with deals. Do you think that deals are a big part of the agenda here, a big part of the reason to own the stock? Do you kind of just think that inevitably they'll be able to outmaneuver or find a way to become operator and owner of a very worthy copper project that's better than anything in their portfolio right now?
Look, I think I'd like to think so. Yeah, I think the proposition at the moment is you get Woodlawn up and operating, you get Sulphur Springs up and operating at the levels that they're, at their forecasting, along with their services business, which I think will continue to grow. They're generating a lot of free cash, and then the question is, well, what are they going to do with that free cash? And I think there's a number of probably second-tier assets across Australia that could come on the radar, which they could perhaps manage and develop better than others. So let's see what happens there. But I think they got a lot on their plate. If they deliver on these assets, they're in really good shape. But it's as we've seen with Northern Star, he's not going to sit still for too long.
It's a compelling proposition for, like, even if the bite size of an asset is seemingly insurmountable for Develop standalone, then it must be a compelling proposition to think of them as a partnering option in some way, shape, or form to get there, because you can pop in an underground operator who might be able to deliver operational improvement versus what's in the model from the vendor at that point in time.
Well, I think you're entirely right. The other factor is the investor base is really crying out for some alternative copper investments, and Sandfire's done an incredible job, but it's priced like a global major, right? So I think there's a space that Develop can grow into and build investor support.
Do you? I know you can buy international stocks, but do you on the ASX? Do you own any Marimaca or any Capstone? If not, why not?
We own a little bit of Marimaca, and I kind of like the project, but again, value-wise, it's not compelling. We've owned Capstone in the past, and similarly, I think there's probably better ways to play it. We do invest globally as well. In the Natural Resources Fund, we're going to have 25% of the fund in internationals. So we own Anglo, we've owned Teck, and we own Ivanhoe. And what I really like about the copper space is really alluding to what we were talking about before. I'm looking to have big positions in the copper groups that have big copper endowments, right? So it's not just, can they produce copper for 5 years? It's can they produce copper for 20 to 50 years? I think those assets are going to be hugely valuable in the future. I don't think that strategic value is really factored in yet.
Ivanhoe's rebounding, and if you catch the tailwinds of commodity price, then it's a compelling thesis.
Yeah.
Let's move on to Ramelius. They came out with a 5-year plan, JD.
It did. So if we look back briefly, $700 million in free cash flow. Obviously, there was a lot of things going right at MA and the rest of it, but that's what they did in the year gone. And they came out with a pretty highly anticipated 5-year plan that would see them sort of go from 200-ish thousand ounces per annum, getting up to 500,000 in 5 years' time as Rebecca Rowe comes online. So we saw the numbers for Rebecca Rowe, which would start construction late 27, come online the year after, as well as a early peek into the numbers at Never Never, talking about sort of putting the dirt through the Mount Magnet hub there. So it's kind of taking the shape that we think the company will be in 3 to 4 to 5 years' time and beyond. Never Never first reserve came out, 1.6 million ounces at 7.3 grams. So obviously what they paid for there. Also talking about scaling up Mount Magnet to 4.3 million tonnes on the back of just keeping the Dalgaranga plant a bit cold there for the interim period. So a lot to kind of dig into here. The market didn't like it. It came on a day when the goldies were getting sold off, but they got a bit beaten up on the back of this. And yeah, curious to hear, Dave, how you were sort of thinking about this one in the lead up to it, how you sort of judged the announcement that came out, and yeah, any kind of nuggets in there you think people might have glossed over.
So it was interesting, Dave, like all of that stuff with Ramelius and Dalgaranga. Dalgaranga, it's Never Never, that the PFS that they put out, it's underground. What do you know that you need with underground?
You need support.
You need ground support. I didn't even have to give you a clue on that one. Yeah. Who provides the best ground support in the industry? Bar none.
I don't know.
I'll tell you. You don't have to know.
Sandvik ground support. There is only one name you need to know in the ground support industry. Everyone out there in the Australian and the global mining community knows Sandvik ground support are the champions at ground support.
They don't. That's not the only name they need to know. They need to know Derek Hurd's name as well, mate, because you just give Derek Hurd a call.
Yep.
Because Sandvik ground support is the best.
We did the QA/QC. We went out to Qdale. We saw all the products being galvanised, being made. We saw the team hard at work, Australian made, servicing the WA industry here specifically, and they're in every other corner of the world. And we know they're working hard at R&D over in just outside of Stockholm as well. So just keeping the mining industry alive. Go Sandvik.
Go Sandvik.
Yeah. A couple of things. So I think the quarterly was a little disappointing on really around the grade on Penny and Q, and I think it got sold off a bit on that. I think the 5-year plan though was probably better than expectations. The challenge that the group has is it's got a couple of flat years until it does the capex, brings Never Never on, and production then ramps up. But you look out to 2030, you got an asset or a business that's going to be generating 500,000 ounces. So ultimately, it's an asset you want to own. The one thing that separates Ramelius from most companies in the gold sector is the management and board are very good custodians of cash, right? It's all about generating free cash and doing something sensible with it, and I think that's a really strong thing. If you look at Ramelius historically, it hasn't had a mine life to really get rated as a major. But I think it's going to have that now. So the question for me is when do you own this? And you probably want to own a little bit now. We don't own it at this point, but ultimately it's going to be a leader in the sector for a long period of time.
There was a punchy comment in there that I saw calling out the all-in sustaining cost would be mostly below $2,000, unlike peers, which are closer to $2,800.
Yeah.
I had a couple names in mind, but
yeah,
we can leave that one there. Trav, what did you think of the 5-year plan?
I think you're right in your analysis of the company, and I love the way they keep themselves accountable by always showing shareholders, here's what we paid for an asset, here's the amount of development capex we put in to bring it online, and by the way, to date, here's the free cash flow that asset has generated, and then we sold it or we kept it, we're still producing. Now there's some big things in that portfolio that are kind of yet to pay dividends because they're being developed, and that was part of the 5-year plan is obviously Spartan and Rebecca Rowe. On Rebecca Rowe, so they're called FID at Rebecca Rowe. Their base case is a 4,500 Aussie dollar gold price. That's $340 million upfront capital, and that'll give them a $692 million post-tax NPV. So if you chop $500 off of that assumed gold price, it's a pretty it's pretty ugly NPV.
Yeah.
Yes, spot is $6,000 an ounce right now. 12 months ago, though, it was $4,000 an ounce.
Yeah.
So why do I point that out? I think in general, like the gold miners are like the corporates, the BD teams, they're gun shy about buying things. They don't want to assume a gold price that's too bullish and then overpay for something in the good times. And here you've got Ramelius assuming, calling FID on an internal project based on a $4,500 gold price. I just think there's some food for thought on that. The producers, one by one, they're gonna be lifting their gold price assumptions in their own models, and I think if it's good enough, if it's a good enough gold price to justify FID on your own kind of sunk projects, sunk capital, then it's probably going to be even more compelling when you run that gold price on the nearby bolt-on opportunities or undeveloped sort of ounces that can feed your mill. So I'm waiting for that.
Yeah, I agree. I reckon the dynamics in the across the gold companies is really interesting because a lot of them have a shitload of cash, right? Like you're talking hundreds and 500 mil cash or more. I think Greatland will have $1 billion in cash by the end of the year, and Ramelius have 700, something like that. So there's cash there. But if you look at, if you take the recent quarterlies as a group, and you look at the free cash flow that they've generated, the free cash flow yield, and you annualise that, right? There's not many. If you annualise the quarterly free cash flow into a yield, there's not many that are yielding over 8% based on the free cash in the recent quarter. So what that means is equity prices have rallied very strongly, and so the value proposition hasn't necessarily improved. So I think that comes to your point that what do you do from here? If you've got script that's essentially factoring in the current gold price, and you've got a lot of cash, you probably want to be buying stuff. Particularly if some of those development projects represent good value, and I think there are still a few out there. So it's an interesting time.
On that theme, it's always interesting comparing Ramelius with Westgold, Murchison Neighbours, and the like, and even the two companies both put out Ramelius' case a 5-year plan, Westgold's case a 3-year plan in the same month. So, and Westgold I think they brought it out on the first of the month. They put out a decent quarterly this week. There was $110 million of cash generation. They've outperformed phenomenally the last couple of months. I think they doubled in the space of a month at one point there. It was kind of crazy. And they did rally on the back of their 3-year plan that they put out there, which was interesting. So they basically, they show this. There's $1 billion of capex that they're going to spend over the next 3 years there. Stock went up 11% that day. Compare that with Ramelius's 5-year plan, and they sold off. How do you evaluate Westgold kind of vis-a-vis Ramelius?
Yeah, look, I think Westgold, if they deliver, they're still relatively, if you look at their production versus market cap, they're still relatively cheap. So they're building credibility. So they continue to deliver on their plan. I think they'll continue to get re-rated because relatively on their free cash generation, I think their free cash generation or the free cash yield for financial year 26 is about 12%, which puts them among the best. So and given that they've also got mine life, that what that says to me is they keep doing what they're saying they're going to do. There'll be a re-rating there.
Yeah, their all-in sustaining cost, I think it went up $200 per ounce in the quarter just gone. It would have been only about $100 per ounce if it weren't for the ore purchase agreement dynamics that play with New Murchison. However, are you concerned by kind of cost creep with a company like Westgold whose assets they're rolled, they're marginal. The temptation is to take a bit more at the edges and produce more ounces, but costs rise when you do that because
Exactly, and there's always that temptation to do it when the gold price is going up because you think, well, the margin's still huge. So you're right. We like to own lower cost producers across any commodity, and that's the same in gold.
We'll see if the discipline can remain across the kind of board, or the all-in sustaining cost just creeps higher and higher and higher.
Yeah.
So it's a trend to kind of watch out for.
Should we go Greatland while we're still talking gold?
Yeah, let's do it.
They're redeeming themselves after a bit of a guidance hiccup. Would you say, JD?
I think they are, and like you said, Dave, sort of approaching $1 billion in cash in due kind of course. So on the day they bounced up after the quarterly. How do you all take it on board? How do you take on the recovery since that point in time? I think that was on the back of the last quarterly, give or take.
Yeah.
So 3 months, and they have performed super strongly. I think the share price went from low 5s up to 8 kind of plus, with a healthy tailwind in the gold price. But you're a shareholder. How are you kind of thinking about it now?
Yeah, look, we like it. We still think it's really one of the standouts in the gold sector. $1 billion in cash by the end of this year, which basically funds the entire transaction that they did, right? So the exploration work they're doing at Telfer suggests that Telfer is going to be operating for a long period of time, and Havieron is a cracking asset. So we thought the market overdid the sell down on the back of the the grade in the stockpile, and we actually bought more when it came off. So we see it as a core gold holding. We think it's one of the best value there.
And deal with Antipa on the horizon or not?
I don't think so. I don't think they need it, right? So, and certainly at the valuation of Antipa, I don't think they'll be going there soon. But we'll see. Yeah.
One to watch.
Yeah.
Why don't we wrap through a couple more quarterlies? Liontown's one of the ones that comes top of my mind, so I'll give a bit of a synopsis quickly. The ore tons they mined, that kind of beat expectations, and then you had realised pricing was perhaps a bit weaker than expectations. The open pit is coming to the end of its time, and more of the tons are coming from underground. You've got Pastefill, the biggest kind of Pastefill plant in the state, churning over. But they got beaten up on the back of these results, so they were down 13%. It was a pretty bad day. Perhaps a couple of questions about recoveries. Like there was a variability in the ore this quarter just gone, and that was partially expected, but recoveries were below 60%. Company kind of maintains its 70% recovery target for the longer term. Balance sheet looking a lot healthier because they did a big raise in the quarter just gone, and they kind of amended the forward facility as well to buy themselves more time on that front. Yeah, curious to hear how you kind of weigh up whether you're in the kind of camp of like things are improving and they're getting closer, or you're in the other side of that debate and thinking they're going to be a high cost producer.
Look, the way I look at Liontown is, I think Tony has done an incredible job of controlling the controllable, right? So from an operations perspective, I don't think you could have asked this project to commission and come on stream and start production any better than it could have. So to me, the issue with Liontown is one, the spodumene price is low, right? And cost of production, even for Liontown, which I think will emerge as a pretty cost-effective producer, but it's way above where they're selling their spodumene for. So you got a business that in the medium term is going to lose money, and it doesn't have a strong balance sheet. So it's got net debt, notwithstanding it's pushed out the forward facility, which I think was the right thing to do. But it just means there's pressure there. So I think it will come through one way or another. Whether it has to raise more equity down the track, who really knows? It will come down to how quickly spodumene prices recover. I think it will end up being a really high quality producer at relatively low cost, but the key driver will be just what happens at the commodity level.
What do you make of the share price? It's like tripled in short order. That's and they're not the only lithium producer.
Yeah, exactly. I mean, Pilbara's the same. You kind of go, the economics don't kind of stack up, right? So the market is saying, arguably, you'd say Liontown and Pilbara are priced as if spodumene is at $1,300 to $1,500 a ton, and it's $800. So there's a bit built in there, right? Now Pilbara is probably the go-to easy way to play lithium, so I can kind of understand it from that perspective. And I think Liontown is probably a credit to the way they've gone about doing what they do, that people will also see that as a go-to in the lithium space. But ultimately, when the commodity price is below your cost of production, right, you got to be cautious as an investor.
Speaking of commodity price below the cost of production, I don't know if it's reported that way, but when cash goes down quarter on quarter, Boss Energy, they reported this today as we were recording. JD, what do you think of the quarterly?
Well, good day to report to be a uranium company on the back of an $80 billion government deal in the States. So I think when I looked, the stock was up 17%, 16%. They're flying. One of the things like we noticed kind of straight away is they're not just reporting what the cash position is. We know they've got inventories, but cash, inventories, investments, and receivables, it sort of feels like it's getting a bit long in the tooth there when you add in every kind of column.
Receivables, but not payables, mate. Yeah.
Well, that would make it look bad. But on an operation side, you've got column 4 commissioning. You've got new well fields being brought online. One of the details I kind of noticed is that the PLS IX tenor kind of dipped, so it went from 88 to 81 in the most recent quarter, which is kind of interesting with new well fields coming online there. Drummed production was up a bit, but IX production was down 20,000 tonnes. So we're talking figures just below 400,000 odd tonnes there. And I think most importantly, what people are laser focused on is that work has started, drilling has started properly delineating resources at the kind of contentious, if you like, deposits they've got out there at East kind of Kalkaroo and others. And you've got the honeymoon review due this quarter, so the December quarter. And that is what a lot of people are fixated on. When they came out with that announcement, the stock just about halved on the back of this. So positives and negatives there. How are you kind of weighing it? How do you think about this and the restart projects more broadly and the uranium landscape on the ASX, Dave?
Yeah, I don't think we've owned an ASX listed uranium stock. And the problem I see is that there's, in Australia in particular, but globally, there's not many uranium stocks of any size or scale. And as interest in the sector has increased, you've had a lot of money flowing in and prices and valuations have been pushed up. So I just don't see the value proposition for a lot of these companies because basically they're relatively small scale, they're relatively high cost, and until you get higher uranium prices, it's just not a compelling value proposition. So, it's a bit like the discussion we're just having that you need the commodity price to be at higher levels to kind of gain some interest. But I think there's better value in a next gen or some of the developers or Denison in Canada and some of the emerging developers out of Canada. Yeah.
Do you have like a rule of thumb or a way of thinking about restart projects in general? Are you pretty open minded when it kind of comes to it?
I think you got to be careful depending on the type of project, but Boss is a good example of what can go wrong. So you just need to be really careful, and you don't want to be paying a premium for them as if it's all going to go right. I think you got to assume there's going to be ramp up and there's going to be a few hurdles along the way.
I think trying to figure out. I think it's going to get better from here, or they get worse before they get better for Boss. And all the answer to that question kind of lies in the geology of East Kalkaroo. They're still producing. I mean, the uranium right now is still dominantly coming from Honeymoon, where grades are much higher than East Kalkaroo. In fact, between 2 and 3 times higher in the early kind of resource models that were resource statements that were put to market. So the extent that East Kalkaroo can string together and you can economically extract much lower grade there, and they have to put in more wells to do all of that, reagents involved and everything. Like, what uranium price does it take for that to make positive cash flow? Yeah. Because it might be an inconceivable uranium price when the Honeymoon resource is all gone. And if that's the case, then things get worse before they get better.
Well, I think you're right. The issue that I had with the sector is it wasn't pricing for the risk, right? So, and obviously Boss has come back from its peak and it's getting a bit closer. But if I'm after, the way I often look at it is once you've made a call on the commodity, I think uranium outlook is really good, then the last thing you want to do is make a poor stock call, right? So your first port of call is to look at the high quality producers or developers and say, are they that much more expensive than the second tier that that I should be bypassing them? And I think in uranium there's been better opportunities than some of these local ones. Yeah,
I think that's well said, Dave. Should we jump into some grade control?
Indeed. You know what we do here, Dave? Great things, A to F.
Yeah.
So we're talking corporate moves, government policy. We've got a few of the above here. And yeah, we can just sort of rotate through them fairly quickly. Let's start with Larvotto, Trav.
Yes, mate. So Larvotto, they came out early in the week, effectively saying that they've rejected the non-binding offer given to them by US Antimony Corp. Now, US Antimony Corp proposed to an all-scrip transaction after basically buying a bunch of Larvotto shares on market the week prior up till the Friday, at a merger ratio that was probably marginally higher than the highest price that they paid at the point at which they announced it. Now, Larvotto's shares upon revelation of this have obviously shot up, and US Antimony Corp, as you'd expect, have come down a fair bit. Larvotto's rejected the bid, and it looks like we're in for an entertaining way that things play out. Underpinning all of this is US Antimony Corp's need to backfill supply. They've got a pretty hefty contract to deliver antimony from the US government, and they're keen to source that from all parts of the globe. In Larvotto's case, they actually entered an offtake with Wogen. I think it was late last year, but from the bit of detail we can actually see about that Wogen offtake, it looks like Larvotto still has some ability to influence where the final destination of the product is, even though Wogen has kind of marketing rights. So US Antimony Corp must have taken the view that they can actually still influence the final destination, and that is the proposition of why Larvotto's a takeover target. What have you made of this one, Dave?
Yeah, look, I think it comes down to time and money, doesn't it? So I think Larvotto have done the right thing. They've said, they batted them away, and they know that the US Antimony are committed, right? They're a shareholder, and they need the asset. So I think from a rating, I'd give them a B. They're doing what you'd expect them to do, but ultimately you'd expect a deal will be done, a price will be set, and it'll happen. Yeah,
trading substantially above the terms of the initial offer right now. So the market's pricing in the fact that an uplift is on its way, and given that the somewhat hostile nature of the buy, the stake, and announcing it and the likes. Yeah, wouldn't be surprised to see an uplift here and an eventual deal. But the shareholders might be hard to keep happy, Dave. I've noticed this about the antimony shareholders. They are, I don't know what price will be the right price for them. So there might be a bit of work to get them on side for a deal, TBD. But I give it a B. I mean, Larvotto paid sweet stuff all for this asset, and in no time it is they're copping a very credible deal worth hundreds and hundreds of millions of dollars. It's remarkable.
I'll give it an A.
Yeah.
Right. A for entertainment, I think. A because, like you guys sort of alluded to and kind of said there, they the counterparty is trying to backfill value, so they're getting paid in shares. You want to make sure they're pretty well kind of priced, and they're just doing the right thing by their shareholders. And that aggressive buying on market was interesting to say the least from USAC. So keen to see where this one goes and how Larvotto can kind of maximise value and cement value for their shareholders.
Yeah.
Next one is a lithium related story. So we're going to talk about Liontown, and we're going to talk about Pilbara here. So the context is the price floors that we've spoken a fair bit about in a variety of critical minerals. So you had Dale Henderson, obviously, who runs PLS, being quizzed, as well as Tony Ottaviano. And they're talking about the $1.2 billion strategic reserve and what a kind of price floor in the lithium world would look like and the implications that would come off the back of that. So I think Dale handled this pretty deftly and very kind of diplomatically. He was sort of saying things to the tune of, if deployed in the right way, these could be positive, but equally there could be bad unintended consequences. The concern people have in this regard is that the wrong projects get supported. And I think, the people being concerned there is Dale, and I think he's, that is the most pressing way you're going to get Dale to say it's a pretty stupid idea. He's never going to come out and say it just like that. And then similar words from Tony, although he kind of caged it saying, we're happy with the National Reconstruction Fund and the way that invests. We just don't want price floors, which is, I don't know how you can hold both those two views in your head at the same time unless somebody's just bought into your capital raise a few months ago and you want to kind of say it that way. On that point, our taxpayer money is now up 40-odd% since the capital raise. So I am all for the fund cashing out that. They've done it. Take it off the table. That's a fantastic win in the space of a few weeks. And to wrap a kind of grade around all of this, I would give it an A again and just kind of be generous because I like the public talking down of price floors. I think the bad and unintended consequences are very real and they can distort the market. Dave, what do you think?
Yeah, look, I think you're right. I'd give them an A or a B, and for similar reasons. I think when governments start to get involved in business, often it doesn't end well. And I think we've talked before. Governments as allocators of capital. I'm not sure you want to be dependent on that and have an industry built around that. And again, as I think you guys have talked numerous times through your previous episodes. What I'd like to see governments focus on is delivering cheaper energy, delivering a greater volume of skilled workers and faster approvals. And any distraction from that is a distraction, right? If they do that, they get those three things right, the mining industry in Australia will boom. And it's all very well to talk about stockpiles and floor prices and all that, but they're around the periphery. The key is deal with the fundamentals first.
I should just add in quickly before you jump in, Trav, that Dale did talk up shared infrastructure as well, to your point there.
Yeah.
Yeah, the infrastructure is the low-hanging fruit. Yeah, and energy is even lower-hanging fruit. Really, that's a political will thing.
Yeah,
we are not competitive. In a variety of different areas, unless we were blessed geologically by having the world's best iron ore. This is not a competitive place to produce from an OPEX perspective, and things need to be done about that. There's some easy things to do. Glad we don't have any price floors. I would have maybe sought citizenship somewhere else if we went there. But anyway, I won't hold my breath because we might get that in other commodities.
Well, and maybe on rare earths, it's one where something in place makes more sense than most commodities. But we'll see.
Yeah. I think in the lithium case specifically, it's not one that makes sense. I think we're kind of in agreement there. Just it's a different kind of ball game dynamic there. Yeah. Let's jump into sweet and sour deal. We can run through a bunch of these. We've got capital raisings, we've got deals and sales, we've got government-ish support being lent as well. Trav, you picked upon Albemarle selling their catalyst business earlier this week.
So they agreed to sell controlling stake in Ketjen Corp's refining catalyst solutions business to KPS Capital Partners and its 50% interest in Uracat joint venture to Axens SA, so generating together about $660 million in proceeds. So this is sweet deal, sour deal. My take is Albemarle, they have the worst balance sheet in the sector. Like, it is number one Albemarle, number two Albemarle, number three Albemarle for most, the worst balance sheet. And that's been an own goal of their own. Would they've sold these if they didn't have to? I don't know. I don't actually know the quality of these businesses, but I do know how bad their balance sheet is, and I guess they might not have sold them if their balance sheet were not in the situation it is. So I think it's a sour deal, but their hand is forced, and that's their own. They've got their own hubris to blame for that.
Yeah, I agree. And again, I don't know the catalyst asset that well, but you'd suggest the only reason they're selling it is because of the debt pressures they've got.
Yeah, sour on long-term thinking. Coronado, so they announced an arrangement with Stanwell, who is a kind of Queensland government arm, talking about $265 million in debt being provided, rebate fees being waived, prepayments being a possibility if cash dips below a certain level. All that is to say, Coronado is in a world of pain. Coal prices are in the gutter, and they are, looking under every couch and in every kind of corner for spare cash to keep them alive. The more interesting point here is that it is the government of sorts that is, bailing them out in a sense because they are a buyer of this product. So Queensland, partly to blame their energy policy for the fact that they have to do this as a government and write a check to a coal producer. So I think it's from that perspective, that's how I'm going to look at it. I'm going to call it a sour deal, but you can sort of slice and dice this one in a few different ways. Have you got thoughts on it?
Yeah, I think it's sour for a number of different reasons. I think from a Coronado perspective, they've probably having a major shareholder that didn't want to be diluted means that they've got too much debt at a time when the commodity price is low. So that puts them under a whole lot of pressure, and hence they had to do this deal. I think it's also sour because basically what you had was a company operating in Queensland where you had a change in the royalty regime, which really crunches them and leaves them exposed when the commodity price is low, and that's forced them to agree to this deal, which really takes out the upside. You know, a lot of people were looking at Coronado because the roll off of the Stanmore payments, you know, was 27, and that uptick was something like $130 million a year, right? Which really underpins the value of the business. So they've had to give away a lot. So I think for a whole lot of reasons, it's sour.
What's the name of the collie coal business that is distressed and the WA government just props it up every year, writing more and more. Anyway, I feel like it's just going that way. You know, it's not good for equity, but like things, it just becomes pseudo-nationalised because you need the power.
Yeah,
equity doesn't win, but
amazing how quick things can turn though.
Yeah,
like 2 years ago, this is a $2 stock.
Yeah.
Perpetua.
Oh, that's this. NASDAQ listed Perpetua Resources. They announced US $255 million strategic equity investment from Agnico Eagle, who tipped in 180 of that, which gave them a 6.5% stake. They got warrants there too. Plus, you see JP Morgan's sexy new security fund. So 75 million from there is part of this raise. So those two parties, both of them got juicy warrants along with it. And then the next day, Perpetua raised 78 million more to a broader audience at a dollar higher per share than the initial deal. Perpetua's key asset, Stibnite Gold Project in central Idaho, supposed to produce both gold and antimony, hence the critical minerals angle here. Dave, sweet deal, sour deal?
Again, I don't know the intricacies of it all that much, but I would have to say it's a sweet deal in that you get Agnico involved, then I think you're doing well.
I say sweet deal for Perpetua. I mean, they locked in strategic capital first and then raised more on better terms. Can I say sour deal for Agnico?
There's not enough upside in it for him. Yeah,
Agnico's they're a classy miner, and they've got I can't in all reality critique their capital allocation. That'd be absurd. But I don't really understand a lot of their strategic stakes in a lot of different companies, and they've got 90 of them. Believe it or not, 90 minority stakes in other companies.
Yeah.
So I do understand most of the gold ones, but I don't understand the non-gold ones that they've got. Like a lot of their base metals allocation have been dubious or curious to me. And then this one, it's Agnico, and they're kind of doing the Trump pump kind of thing. Like I don't know. They're Agnico. I'm a podcaster, but I just think sour deal for Agnico.
Yeah, interesting.
Very interesting one. I like the JP Morgan security fund you mentioned. I think it's called like the America First Fund or something like that. That kind of cracks me up. Yeah, on Perpetua, I think it's a sweet deal. You got to take the money whilst you can get it, and this is the environment to take it on board. Really, really kind of fascinating from an Agnico perspective. You mentioned the 90 other stakes they've got. Most of them are a lot smaller than this one. This is a fair bite size for them to take. So, yeah, I wonder if there's a kind of you scratch my back, I'll scratch yours, and they get something kind of decent in America, or something becomes a bit easier for them for getting this Stibnite gold project off the ground. So we'll see about that one. Another one with government involvement. Oh, mate. Arafura.
The big capital of the world, all in this one deal, mate. So Arafura raised $475 million in a 2-tranche placement at 28 cents per share, 25% discount to last. Hancock, Gina, tipping in 125 million of that, and that'll bring her stake to about 16%. Now, Arafura, they say that the proceeds of this raise, together with the 50 million SPP that they're also doing, will complete the public equity component of their Nolans Rare Earth project in the middle of Australia. FID on Nolans, though, is expected early next year, and Hatch is the preferred EPCM of that. I'll give my take first. This is not the final public equity component of Nolans. Sour deal. Happy for the Arafura shareholders who've had a win in recent months, but sour deal.
Yeah.
Dave, who are you going to rate here, and how are you going to rate them?
Well, I think if you're rating Arafura, it's a sweet deal because they're capitalising on the market and the interest in rare earth space, and the fact that Gina's really underpinning the raise. I think Gina has a longer term time frame and assessment period than a lot of investors. So, but I think from a value proposition as a investor coming in, I think you've got to be cautious, because I think there's two things that rare earth projects like this, the hard rock ones in particular, need. One is capital and the other is expertise. And if you look at Lynas as an example, it took them 20 years to get their Mount Weld and processing activities up and running. So I think there's risk in the sector because it's difficult. So I think Arafura have done the right thing. They've grabbed the cash while it's been available. So good on them.
Yeah, similar to how you think about it, Dave. I'm very cautious about the rare earths world, and for that reason, I haven't partaken in the 10xing of multiples of these stocks around there. And I think once we get to that point in time, FID construction, we'll really see what Arafura and Nolans is all about. But
why the rumour sell the news on the rare earth stocks the last few weeks? Have you noticed that?
Yeah,
very much so.
Yeah.
So I think you got to, like we sort of said, would I have tipped into that capital raising? Probably not. But what do I kind of know about it? I think it is interesting from that perspective, and also the evolution of Gina as the kind of dominant shareholder in a whole bunch of rare earth names. Like, that is not something I would have forecasted a few years ago. And she, like you sort of rightly say there, these aren't the biggest checks in the world for her. She can think long term about these things, and very curious to see where that kind of evolving dynamic goes and what she might look at next. Because it started with kind of lithium, now rare earths. Where does that kind of portfolio grow to?
Yeah,
but that's actually an interesting point on, like, there are limited sources of capital that are willing to write big checks which are necessary to progress projects, and you have to have a long-term time horizon. We're blessed that our mining industry has created a number of billionaires who and some of them are willing to write checks like that. So Gina's capital is tremendously important to the future prosperity of the industry. But the conditions for that capital need to be appropriate for her to be even more interested in investing in Australia. I do know that you look at some of the numbers of the US investment she's made lately, just trumps a lot of the capital we're talking about in some of these positions.
Would love to know what she thinks of all this government involvement. She's awfully close to it.
I think you can research some of her thoughts on government involvement.
As it pertains to some issues, definitely.
Yeah.
All right, Medallion and Aeris to wrap things up. Trav, do you want to kick us off with Medallion?
Medallion secured an exclusive agreement with Trafi for up to US $50 million funding via senior secured prepayment facility and a 7-year copper and gold offtake for its Ravensthorpe gold project and Forestania operations. My take, we don't have all the details yet, so we can't be precise in giving it a sweet deal, sour deal. But I go out on a limb and call it a sweet deal anyway. The just the quantum, the counterparty, it just reminded me of the AIC 50 million Trafi facility as well. These, and what is that? Like, what's the common theme here? Miners and developers who are able to fund their growth without as much equity dilution and on okay terms, because smelters everywhere are desperate for concentrate, Trafigura included. Yes, they make money on the marketing. Yes, there'll be hooks in the offtake, but this is a point in time where you as a miner can actually get some of that upside yourself and avoid the dilution, and maybe it's actually more attractive capital than project finance. So good deal, sweet deal.
Yeah. Look, I agree with you. I think it's a sweet deal. Obviously, we don't know all the terms and conditions attached, but I think you're right. It's better than further equity dilution, and it's probably less onerous than a debt facility. So makes sense.
Agreed. The capital landscape right now is pretty competitive, so hopefully the terms are quite good, and on the back of that, sweet deal as well.
Last one to wrap it up. Aeris launched an $85 million capital raise priced at 45 cents a share, 13% discount. So, and what are they using the funds for? To repay debt owed by major shareholder Soul Patts. So Soul Patts, I think they own 31-ish% of the stock, but they're also a big lender. And Soul Patts, how did all of that happen? Well, they sold them the Round Oak assets, and so I'm giving this a sweet deal. Check out the chart of Aeris on the focus chart by Market Tech that we're putting up right now, and like the fact that Aeris is a $500 million company just crept up on me. And here we are. It is raise $100 million while you can and get improve your balance sheet. Like absolutely sweet deal.
Yeah, I tend to agree. So raise the money while you can, and I mean I think it's been a bit of an underperformer, but strengthening your balance sheet this time in the cycle makes sense.
It'd be absolutely mad not to take that money at that share price. All right, guys, let's wrap up with some hidden gems. Trav, kick us off. What's capturing your attention?
My hidden gem, mate, it's AGM season. If you don't get stuff mailed to you, then the announcements of the stocks you own, you'll see this thing there called a notice of AGM. Open that up, and on there it has the meeting location and the time and date of the AGM of the stocks that you own. And my one suggestion to listeners out there: go to an AGM this year. Just pick one of them. Maybe your favourite stock, or maybe a stock that you just like. You think there'll be something worth attending. Like, just go to an AGM. You will learn a hell of a lot more than reading any announcement they put out, and you have access to the board, which is usually kind of pretty tricky to access for a lot of these stocks. Massively underrated.
Dave, what have you got, mate?
So my hidden gem is holidays. So I've just come back from holidays in Laos at a town called Luang Prabang, which is on the Mekong River. Beautiful spot. Now is the time of year to go, between now and December. Otherwise, it gets a bit hot and steamy. But a fascinating country. It's about 7 million people. It's the most bombed country in history. It's on the Mekong River, which is beautiful. Most of the population are Buddhist, and also the government is communist. So it's kind of got something for everyone.
That is fascinating. You fly via Thailand to get there, or?
So you can actually fly directly into the capital, which is Vientiane, from Perth, which is interesting. Or alternatively, you go through Thailand and then.
Direct flight, very, very appealing. I like it. I will wrap up with my hidden gem. It is a record player. So I've become a snob that listens to records now, total snob. And
I bought one when I lived in Melbourne too.
Yeah, it just happens to you when you go over there. And I think it's a sort of fantastic thing just to chuck on a record, listen to the whole thing through, gets you, you can just enjoy a piece of work for 30, 40, 50 minutes and feel the flow through a whole album as opposed to just a song. So if you want to be a snob, get a record player. Oh. There we go. Thanks a bunch for joining us, Dave. That was fantastic to cover so many topics with you. Much appreciated.
No, my pleasure. Good to be here again. Yeah.
It's great to talk about the stocks that we love, Dave, and great to see the Natural Resource Fund, going from strength to strength. So congrats to you and
great to see the Sandvik ground support business just supporting the whole industry, and the charts right behind Dave's head you can see there, brought to you by Focus, the platform that Market Tech does. Check him out.
Hooroo.
Hooroo.
Cheers.
Now remember, I'm an idiot, JD's an idiot. If you thought any of this was anything other than entertainment, you're an idiot and you need to read our disclaimer.